All right. Hello and welcome, everyone. My name is Kristen Biermeyer. I'm the marketing manager at Wagner CPAs, and I'm so glad that you could all join us for today's webinar, as Tim will be talking about some accounting and audit updates for nonprofits. During the presentation today, if you have any questions, those can be submitted through the Q&A feature that's at the bottom of your screen. We'll try and address those either as they come in as appropriate or at the end of the webinar. The presentation is being recorded today, and you'll receive a link to view that recording as well as the PowerPoint slides in an email from me after the event today. Our speaker today is Tim Seidel, and he is a partner at Wagner CPAs. And with that, Tim, I will turn things over to you.
Great. Thanks, Kristen. Welcome, everyone. Thank you for joining us. I hope everybody's doing well during these challenging times. As Kristen said, I'm Tim Seidel, a partner with Wagner CPAs. I've been with Wagner for a little over 12 years now, working in our assurance department with both not-for-profit organizations and closely held businesses. And as of the beginning of the year, 1/1/22, I'm also going to be leading our quality control function. So kind of the roadmap for today's webinar is going to discuss our new auditing standards and what it means for you, accounting standards that are going to be effective for 2021, most specifically gifts in kind, then accounting standards effective in the future, which is primarily going to be discussing the new lease standard. And then we'll end with some COVID-19 funding and just a short little compliance update. You'll see some various examples and flowcharts throughout the presentation. Some of those flowcharts and examples have been taken from some AICPA materials. So the new auditing standards and what it means for you. There are several new auditing standards. They're called SASs, S-A-S, and they stand for Statement on Auditing Standards. The following slides are going to discuss some of those changes as it relates to financial statement audits. There are some additional updates as it relates to employee benefit plans, reviews, agreed upon procedures that are not going to be discussed in the presentation. So the first new auditing standard is SAS 134, and it relates to the auditor reporting. So the most significant change here is how the auditor's report is going to look. Specifically, the opinion paragraph is going to be presented first. The basis of opinion is going to follow directly after that with some additional language in it. There are also expansions to the auditor's responsibilities and management's responsibilities and potentially going concern evaluations when required or if required. There is also an additional change to, excuse me, require the auditor to discuss significant risks with those charged with governance, so your board of directors. Now, again, these are mostly changes that are on the auditor side, but when you're reviewing your financial statements, your audited financial statements, they are going to look just a little bit different than how you've seen them in previous years. And then the next auditing standard update is the SAS 135. So what the AICPA wants to do here is enhance our audit quality by having us focus in more on related party transactions and if there are any significant unusual transactions. So again, what does it mean for you? Likely it is going to involve additional questions and probably people who may not have answered these questions before may be getting some different questions as well. And with this new standard, the auditor is required to communicate the following with those charged with governance. So again, back to our focus on related parties and significant unusual transactions. So if we have any significant findings from them, they will be included in our letter to the board at the end of the audit. If there are any difficult or contentious matters where we need to consult an outside party, that will be communicated. Generally speaking, that doesn't happen very frequently, so I would suspect that most of you would not be seeing that communication. And then finally, uncorrected misstatements. Now that has always been part of the communication with those charged with governance, but there's this additional piece at the end where it discusses matters underlying them that could potentially cause future period financial statements to be materially misstated. And then included in this is an additional representation in the management representation letter at the end of the audit. So again, not a lot that's going to really impact you, just more so, FYI, things will look just a little bit different, and we'll have some additional questions and procedures around related parties and significant unusual transactions. So to that effect, related parties, we already do make some inquiries, but we'll probably make some additional inquiries of additional personnel, whether that be within the organization itself or with those charged with governance, so your board of directors. And then we also have a requirement to evaluate whether you all have properly identified related party relationships and transactions. And then in regards to significant unusual transactions, the FASB introduced this concept here and defined the term for significant unusual transactions as those that are outside the normal course of business for an entity or that otherwise appear to be unusual due to their timing, size, or nature. Being still kind of in the COVID environment, top of mind are kind of our COVID fundings that might be significant unusual transactions like a PPP loan. And again, we're going to be making inquiries of management and those charged with governance. If we identify them or if you identify them for us, we'll provide some additional procedures over those transactions and maybe even some additional ones if they involve related parties. So that kind of concludes our just quick little SAS update there. The next kind of section of our presentation is going to be accounting standards that are effective for 2021. Now, the good news for everybody is that it's a relatively light year for new standards. I think if we kind of review the last few years, it seems like we've had a lot of new standards that have come through. Again, ones that jump out are revenue recognition was a significant new standard, along with the contributions standard as well. So thankfully, this year, probably the most significant standard that will affect nonprofit organizations is going to be this gifts in kind. It is effective for periods beginning after June 15, 2021. So for everybody on the call, that starts with June 30, 2022 year-end audits. So this is not going to be effective for your December 31st, 2021 audit. Those of you with that fiscal year end, it will be effective for your December 31st, 2022 audit. But for those fiscal years with June 30th and later year ends 2022, this standard will impact you in your next audit cycle. So the gifts in kind standards, ASU 2020-07, the formal name is presentation and disclosure for contributed non-financial assets. What does it mean? It's your donated services and your donated materials. The objective is just to increase transparency around those non-financial assets, along with how they are used and how they are valued. So when we say non-financial assets, we mean fixed assets, the use of fixed assets, materials, supplies, intangibles, other services. The one thing to note with this standard is that retrospective application is required. So if you present comparative financial statements, you will need to do it for the year prior. So again, back to when this standard is effective, for our calendar year-end clients, we don't have to show this in your December 2021 audit. But when we get to December 2022 audit, we're going to need that December 2021 information to show comparatively if you choose to show comparative financial statements. All right, so why is transparency important? Many nonprofits receive and use significant amounts of gifts in kind. The value of these gifts in kind can impact key metrics such as the program expense ratio. It can also have significant implications for financial or programmatic sustainability. For instance, if an organization is heavily reliant on gifts in kind to run its programs, a decrease in that level of donation would require the not-for-profit to decide whether to spend its cash to make up the difference, or potentially reduce the level of its programming. So kind of an overview of the requirements. The main thing is it does not change how you're going to recognize and measure the gifts in kind. The standard is just an update for how it is presented and disclosed in your financial statements. So when you get to your statement of activities, it is now required to be shown as a separate line, or you could show it as a separate column. Subsequent slides here will have an example of that disclosure or presentation. And then we are also required to disclose information about how the assets are used or monetized, along with any potential donor restrictions and how the organization is valuing those contributed non-financial assets. Additionally, you will need to disclose the types of non-financial assets that have been recognized during the reporting period by category. So think of food, rent, professional services, those types of categories, and then how they are used. So is it being used in a program? Is it being used in management in general, or admin, or fundraising? And then when we say monetizing, that's going to refer to if you receive something, excuse me, an example being like a vehicle. If you receive a vehicle and you sell the vehicle immediately rather than using it in your program, that would be an example of monetizing that contributed non-financial asset. The following slides will kind of go through just some examples, just so everybody can picture and visualize it. So this slide will show the separate line example presentation. So, before the standard, some organizations would include in-kinds as part of contributions. With the adoption of the standard, that in-kind or donated materials, or whatever description you used, those contributed non-financial assets need to be on its own line, such as this example, or it can also be presented in a separate column. I suspect we'll probably see the previous slides presentation being the common example. Excuse me. And then when we get to the footnote, here's kind of some examples of what a footnote might look like. So for the year ended June 30th, contributed non-financial assets recognized in the statement of activities included the following. So in this example, we have food, legal services, and a vehicle broken out by without donor restrictions or with donor restrictions. Now, if you only had without donor restrictions, you might not need both columns, and you could just simply state that. But in this example, we have both featured here. And then the rest of the disclosure would talk about kind of how these are valued. So I'm not going to read this for you in its entirety, but it talks about the types of services or materials received. So our food, legal, and vehicles, discusses that there weren't any donor restrictions with the exception of the vehicles. And then the rest of the paragraph discusses how the non-contributed financial assets were used. So food was utilized in the food pantry program, and then how we got to the values of the items that were received. So food was based on, as you see there, fair value of estimates, providing they would be received for selling similar products. Vehicles, we have a policy here for monetization of them. So the not-for-profit has a policy to sell all contributed vehicles immediately upon receipt. This slide discusses commonly missed gifts in kind. So as you're thinking about your organizations and what they receive during the year, common things that we see missed are some advertisement, use of facilities, sometimes personnel costs from an affiliate, contributions for fundraisers, and those types of items. And then kind of just a few additional accounting standard updates that are going to be effective for 2021. The first being our cloud computing implementation costs. More and more organizations are moving some of their programs, their softwares to the cloud, and it's raised the question of, well, what can we capitalize or what can't we capitalize? So this accounting standard update clarifies that, and it requires organizations to capitalize certain costs and amortize them over the term of the hosting arrangement. So think of it as similar to internally developed software in that you're going to expense costs during the preliminary and post-implementation stages. So think of your planning stage, data conversion, overhead, and then any training on the back end. And then you're allowed to capitalize costs during the application development stage. So if there is coding that needs to be done or other configuration or customization, those are the types of things that can be capitalized. The next one there is the reference rate reform. This isn't, I suspect this won't really have an impact to most organizations. The FASB came out with this because the LIBOR rate, so the London interbank rate, overnight rate, is going away. And so there are certain contracts that are tied to the LIBOR rate, for example. And so those contracts are all going to have to be modified. So the FASB came out with this update to say when a modification needs an accounting change, or if you can just modify and go forward like nothing ever happened. So I suspect with most organizations, this will not have an impact unless there are those with some hedge accounting that is tied to a labor rate. There might be some changes there, but those are fairly complex and not planning on discussing them today. And then the last one on here is related to goodwill. So again, most nonprofits that I see and work with don't have goodwill on their books, but some do. So this accounting standard update allows organizations to make an election to evaluate goodwill for impairment at the reporting date. Previously, organizations would have to monitor their goodwill throughout the course of the year for a triggering event and then evaluate for impairment. The standards tries to simplify it just to only look at it once at the end of the year through this accounting policy election. And then before we move on, Kristen, was there anything in the Q&A that has come up over the
Hi, Tim. Yeah, thanks for asking. We do have a few questions here. I'll run through and you can let me know if you've already answered them or if you can give a brief answer for us. The first one is, can you give an example or two of unusual transactions?
Yeah, so I think I may have answered this one, but the first one that comes to mind is, our PPP loan. It's a significant unusual transaction in that, it's not an everyday loan that you go to the bank for. It could be accounted for via the debt model, so as a loan, or it could be accounted for using the grant model as a contribution, and similar to other government grants. So that would be an example. Other things I would say are just kind of those significant one-time events. So if you have a very significant event out of the ordinary, out of your normal year, that would probably be something that as an auditor, we would want to know about.
All right, thank you. The next question is, if the landlord includes utilities and janitorial and rent, is that considered in kind?
That would probably require an evaluation whether your rent is below market or not. Now that's a hard evaluation, but you'd have to look and see if you're paying, kind of a market rate, or if you're receiving a below market rate. And in that case, then you might have some in kind there. So it'd be dependent on kind of the facts and circumstances.
Okay. Are below market interest rates really below market if there are LURAs?
I'm not sure what LURA means, but I think below market could be considered in kind. I'm sure there might be ways to wordsmith your way out of saying that it is not a below market rate. But if you're, an example being, what if you received a 0% interest loan? That is obviously below market rate, because you can't go to the bank and get a 0% interest loan.
And the person that asked that question just responded that an LURA is a land use restriction agreement.
I'm not very familiar with those, so.
Okay. All right. Next question is for gift in kind, fundraising auction items. Does each item need an entry, or can you put in a total value?
So with fundraising auction items, those should be valued based on what you auction them off for. Using a total value would be fine. I would assume you'd have an itemized list anyways, but entering them at a total value based on the cash you received is how you should record those.
Okay, thanks, Tim. I've just got two more here to go through, if that's okay with you.
Yeah.
Okay. In kind, does this include professional services which have been discounted to the NFP? In other words, billable rate is $100 an hour, but they provide a 50% discount.
Yes, that would include those. I would say that you can use kind of materiality thresholds in your assessment. So if your 50% discount isn't material to your financial statements, you wouldn't have to record it. But technically speaking, yes, as long as those professional fees are kind of the market rate for those services, and they're not a discount on an exorbitant rate, like say somebody was billing out, say an accountant was billing out at $1,000 an hour. That's probably not market for, at least around here.
Okay. And last question I have for right now, did you say the cloud computing implementation capitalization is required or it's optional?
It would be required, but again, it's, go back to materiality as a material, and then with the cloud computing, there's they break it down kind of into three different phases. The preliminary phase, so when you're doing your research, that's all expensed. Post-implementation stage, so after it's up and running, training, data conversion, those types of costs are expensed as well. And then the only thing that's capitalized is our application development stage. So if there is significant like customization, those are the things that could be capitalized or would be capitalized and amortized over the term of the agreement. Most organizations that I work with and see, they don't there's not a lot of customization. There are significant costs in the data conversion side of things, which is expensed.
All right, thank you. Back to you.
All right, perfect, thank you. All right, so the next section that we're going to talk about is accounting standards that are going to be effective in the future. So on the next probably 20 or so slides, we're going to be talking about leases. That's kind of the elephant in the room that is coming. It was supposed to come a couple of years ago, and then the FASB delayed it. The FASB delayed it again with COVID. They recently discussed delaying it again. I think it was last month, and ultimately decided no, we are not delaying it any further. You know, we've given private companies and not-for-profit organizations, you know, several years to kind of get their leases organized and discussing it. So, you know, we feel that everybody should be adequately prepared. Now, whether that's true or not, you know, that's yet to be seen. But long story short, it's coming, and it will not be delayed any further. So a quick overview of the new standard. So it's going to be effective for our calendar year 2022 organizations. So thinking of kind of your audit cycle, we're going to be auditing it in 2023. But it's going to be important to talk about this kind of over the next, year, because it is a very significant change. It is a complex standard. Just to give you some context to that, I think the standard itself, the ASU, the Accounting Standard Update, was about 500 pages long. Not that I read it, because that might be a little crazy. But it is, just to give you an idea, it is very complex. Our firm recently had an all-staff training for 8 hours, and some of the comments afterwards where people were asking, when's the next training going to be? Because we're still not quite there yet. So that being said, the most significant change in the standard is that for lessees, it's going to bring your leases, most of them, onto your statement of financial position as an asset and a liability. Kind of the FASB's overall thought process around this goes back to how assets and liabilities are defined. So assets are going to be our probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. So thinking of leases, you're entering into a lease to utilize an asset, to utilize a piece of equipment or space. Sounds like an asset because you're going to be receiving those economic benefits. And then the liabilities, the formal definition is probable future sacrifices of economic benefits arising that the entity is obligated to make. So again, entering into a contract, thinking of leases again, that sounds like a liability. So in theory, it makes sense to put them on there, because thinking back to old GAAP, capital leases were put on the books, but operating leases weren't, yet they were relatively similar with different, there was obviously some valuation differences and requirements on when you classify them as a capital or operating lease, but in substance, they're both leases or assets with future payments, i.e. liabilities. And if you think about it, I think most organizations are going to be impacted by this new standard. A lot of organizations rent their space or copy machines we see a lot of. Now, we'll get into materiality again later, but just as we go through these slides, think of your own organizations and kind of the items that you lease. All right, so the good news, maybe good news, is that public companies have gone through the process. Now they're obviously significantly larger, but we can glean some insights from their experiences. The bullet points here kind of list out some highlights. It may affect compliance with contractual agreements and loan covenants. So thinking of some loan covenants, a common one might be debt to equity ratios. So if we're putting assets and liabilities on your statement of financial position, your liabilities are going to go up and your net assets are going to stay the same. So your ratio just got worse, which could violate loan covenants as they're currently written. Difficulties, so remeasuring the lease liability and when to make the remeasurements. Segregating between lease and non-lease components. Now, again, we'll go through some of these things in the following slides, but just want to point these out. So determining our discount rate or incremental borrowing rate. How do we treat variable lease payments? And then at the end, we'll kind of go through a little bit of transition guidance along with disclosures. And then ultimately, kind of where we, as a firm, we've ended up is like thinking we're probably going to need some software to calculate this. If an organization has one lease, it may not be that difficult to calculate it. But if an organization has several leases, all of a sudden the calculation gets significantly difficult and complex. So kind of just a general accounting overview. So the top part of this slide is finance leases, formerly known as capital leases. And then below that is operating leases. So again, on our statement of financial position or balance sheet, we're going to have a right-of-use asset, the ROU, and then we're going to have a lease liability. On the statement of activities, if we have a finance lease, it's going to be amortization expense and or interest expense. If we have an operating lease, it's going to be lease expense on a straight line basis. So what I mean by that is if you have a lease, for example, a 3-year lease, year 1 monthly rent is $1,000, year 2 monthly rent is $1,100, and year 3 monthly rent is $1,200. If we take all those payments divided by the 3 years, we get a monthly expense of $1,100. So even though you pay $1,000 in cash, we're going to be recognizing an expense of $1,100 in that example on a straight line basis. And then how it impacts your statement of cash flows. In a finance lease, the cash paid for principal and interest payments, and then it's the same as it was as a capital lease, and then in an operating lease, it's just going to be cash paid for these payments. This slide is going to kind of just go over our how do we classify a lease between finance or operating. Now with the new standard, it removed the bright line tests. So if you think of old GAAP, to have a capital or a finance lease, you needed to meet certain criteria. One was being 75% of the leasing an asset for 75% of its useful life. The present value payments being 90% of the fair value. It included a bargain purchase, or it had title transfer at the end of the lease. The new standard, as I said, removed those tests and put these in place. So ownership transfer, that's the same. The lease grants the lessee an option to purchase the asset that the lessee is reasonably certain to exercise. So that's kind of in place of the bargain purchase. An example being if you're leasing a piece of equipment and then you're going to buy it at the end of the lease for whatever it says in the lease. That if you're reasonably certain to purchase that asset, It is now classified as a finance lease, even if it's not the bargain purchase. So, you know, old GAAP bargain purchase meant $1. In new GAAP, it's whether you're reasonably certain to purchase it or to exercise that option. So with reasonably certain, you know, what does that mean, right? So it's a relatively high threshold of probability. So is there, you know, when you think about it, does the organization have a kind of compelling economic reason to exercise the purchase option? You know, those are kind of the things that we would think about if in evaluating whether you would be reasonably certain to exercise that option. And then the middle one here, lease term is a major part of the remaining economic life. Now, while that bright line 75% test was removed, I suspect that most organizations and accountants will still use 75% as kind of a threshold, even though it is not explicitly stated in the standard. Same thing with the next item. So present value of lease payments are equal or exceed substantially all the fair value of the asset. So again, that 90% was removed, but I think in practice, we're going to see that 90% still kind of being the standard there. And then they added a fifth criteria here. So the underlying asset is so specialized in nature that it has no alternative use to the lessor at the end of the term. So what is a lease? Now, in order to perform these calculations, we're going to need to know, one, if we have a lease, two, what the lease term is, three, what our discount rate is, and then four, kind of what payments do we include. And so we'll go through kind of each of those in some of the following slides here, but you know, first out the gates, what is a lease? So a lease is a contract or part of a contract that gives the organization a right to control the use of an identified property, plant, or equipment for a period of time in exchange for consideration. So one of the key things here is that it must be a physical asset. So it doesn't apply to intangibles, it doesn't apply to inventory, doesn't apply to assets under construction. And I guess, you know, kind of relating it back to what we previously talked about, donated use of assets. So think of your rent, donated rent. It's not in scope of the lease standard, but they are going to be subject to our gifts in kind accounting disclosures. One of the things that has come up as organizations evaluate whether they have a lease is that the new standard has uncovered a variety of things that organizations don't traditionally think of as leases. You know, think of advertising. If you're purchasing advertisement on a billboard, for example, and it's a multi-year agreement, that billboard is a physical asset. It's for a period of time, and if you're paying to use the billboard, that would be consideration. So the billboard itself could be a leased asset in that example. Another area that we've seen is think of your outsourced IT functions. If you're outsourcing some of your IT functions, think of maybe data storage. So you're renting space on a server or something like that, or they're data centers. If there are, you know, there's certain criteria, but those things could potentially be leased assets because they are physical assets. We'll get into some more details, but there could be additional things that we think of that are kind of non-traditional leases, like equipment or facilities. So identifying a lease, kind of the pyramid here. So lease contracts and scope involve, we need these in the middle layer, kind of these two things. So we need an identified asset, and then we also need the right to control the use of that asset. So when we talk about an identified asset, this can be explicit or implicitly stated. So when we say explicit, it says, all right, you're leasing this piece of equipment. That would be explicit. Implicit are also referred to as embedded leases, and those are generally seen in our service contracts. So agreements that bundle a service with a device. So again, back to our outsourced IT arrangements, data centers, servers, they could grant you exclusive use of those assets, and it might qualify as a lease, depending on how the contract is written and structured. And then on kind of the right half of the slide, so our right to control the use during the lease term. So we have an asset, do we have decision-making authority over how the asset is used? And then also, do we obtain substantially all the economic benefit from the use of that asset? So thinking of identifying an asset, so when we're looking at the contract, we can walk through the steps here. Does the contract require the use of an asset? If it's no, then obviously there is no identified asset. But if it's yes, is there substantive substitution rights? So what that is referring to is, can the lessor substitute a different asset in its place? So if the answer is yes, then it is not an identified asset because the lessor can put in whatever it wants to satisfy the contract. If it's no, then does the contract require or request use of all or a portion of the asset? If it's all of the asset, we stop and we have an identified asset. If it's a portion, then we move on to the right again. So is it substantially all of the capacity? If it's yes, then again, we have an identified asset. If it's no, we get into this, is the portion physically distinct? If it's yes, then we have an asset just for that portion. If it's no, then we do not. All right, so that was kind of a brief overview of what is a lease and what is an asset. So now, if we've identified that we have a lease, what is the lease term? So it would be the non-cancelable period in which the lessee has the right to use the underlying asset, and potentially includes options to extend if the lessee is reasonably certain to exercise, options to terminate if they're reasonably certain to not exercise, and options to extend in which the exercise is controlled by the lessor. So with those three options, extending, so a lessee option, if you're reasonably certain using that kind of high probability threshold, options to terminate. So this would be, think of a 5-year lease, but as the lessee, you could terminate it after 3 years. If it's probable, if you're reasonably certain to terminate it after 3 years, then your lease term would only be 3 years versus the 5 years. And then options to extend in which the exercise is controlled by the lessor. So if it's a lessor option, the standard automatically assumes that the lessor would extend the lease. So if you had a 5-year lease with a 3-year renewal with the option controlled by the lessor, you would automatically assume that it will be extended, and therefore your lease term is going to be 8 years. So the initial 5 plus the 3. Now, thankfully, the standard does allow a short-term lease exception. So for leases that are less than a year or 12 months or less, the lessee is permitted to make an accounting policy election not to record a leased asset or a leased liability. I guess the one caveat there is it needs to be applied consistently, so you can't pick and choose. And then the standard also says that a lease is no longer enforceable when both the lessee and the lessor have a right to terminate the lease without permission from the other party. So just kind of a couple examples here. So there's a lease, non-cancelable period of 3 years with a mutual option to renew for an additional 3 years. What's the lease term? The initial lease term is going to be 3 years because both the lessee and the lessor have to agree to renew it. If it was a 3-year with a lessor option to renew it, it would be 6 years. If it was 3 years with a lessee option, you would go through the exercise of whether you're reasonably certain to exercise that option. And if you are not, it would be 3 years. If you are reasonably certain, you would use 6 years. Now, the second question on this slide, so a lease term is for 48 months. The lessee has an option to extend the lease for an additional 12 months. They are uncertain at the end of 48 or 60 months, depending on if they exercise it. The lease may be continued on a month-to-month basis in which either the lessor or the lessee can cancel without penalty. So again, what's our lease term? It's going to be 48 months as the lessee is not reasonably certain it will exercise the option. And month-to-month options are not included in the lease term, as both parties could cancel the lease should they choose so. Now, when you think of your lease contracts, it's not unusual for there to be multiple components. The standard says that you should account for the lease component and non-lease component as separate contracts. And only the lease components are required to be accounted for under 842, so asset and liability calculation. In an effort to save time and help ease the accounting burden, the lessee may elect to not separate lease and non-lease components. Now, the reason for this being is that if you have lease and non-lease components, you need to separate them out and allocate the cost based on relative standalone price. So if you're thinking of your lease and you identify lease and non-lease components, your contract may only have, well, hey, you owe us $1,000 a month for these two things. Well, you would need to go through the exercise of saying, okay, well, what's the fair value of the lease component? What's the fair value of the non-lease component? And now we're going to allocate that $1,000 monthly fee accordingly based on those standalone prices. So in other words, it's going to get kind of relatively complex, and it may not be easy to identify what the standalone prices are in non-lease components. Now, using the election, kind of the pro of using the election is it makes the accounting easier. The con side of it is it's going to make your assets and liabilities larger because you're going to be including that full $1,000 monthly payment in my example as in the calculation rather than bifurcating between lease and non-lease components. The discount rate, so kind of that third element that we need to identify. If the rate is implicit in the lease, we need to use that. If we can't readily determine that implicit implicit lease rate, the organization should use its incremental borrowing rate. What does that mean? So that means, if you were to go to a bank and get a loan to purchase, let's say it's a vehicle, what would the bank loan you the money at? Would it be 3%, 4%? Again, unsure, but that would be what the incremental borrowing rate is. Now, again, it may not be easy to determine that, so there is an accounting policy election that not-for-profits can use that says that if they can use the risk-free discount rate, so your federal funds rate. The positive to the election is that finding the risk-free rate is easy to do. The federal funds rate is posted. The negative side to it, or the con, is that when we think of the federal funds rate, it's relatively low compared to financing you receive at a financial institution. So what that means is that using a lower discount rate is going to result in a higher value for the assets and liabilities. So thinking back to our kind of highlights slide, if there are like loan covenants that might be impacted, having a higher asset and liability could be a negative there. Kind of the last thing is our payment streams. So, of course, the monthly payments, the fixed ones, those are relatively straightforward, but it could get a little complicated if you're dealing with variable payment streams. So those that are dependent on an index or a rate like the CPI would be initially measured using that rate and going forward. So you don't have to estimate the future rate increases. You would just use the initial payment going forward when you value the asset and the liability. If you are reasonably certain to exercise a purchase option, that would be included as a payment stream. If you are, again, reasonably certain to terminate a lease and there's a penalty for terminating, that would be included in the payment streams. And then we get to kind of materiality. So we've gone through and kind of discussed high level, theory of what things mean. Now, when you think of, the leases in your own organizations, one thing to keep in your back pocket is materiality. So while the standard does not include any recognition or measurement exemption for small leased assets, the thought is that organizations would likely be able to adopt a reasonable capitalization thresholds where if it falls below that, the organization would not record leased assets and liabilities. So think of, generally speaking, it's probably consistent with your other accounting policies, like a capitalization of fixed assets. One leased asset that comes to mind that we see quite frequently is like think of a postage meter. Now, while that's an asset that you're leasing, the total payments is probably immaterial. Another thing that could be immaterial would be copy machines. Some of those might be material depending on the length of the lease, but those could be smaller assets, leased assets that might fall in that immaterial kind of bucket. Now, when we're calculating the lease liability, so it's going to be measured at the present value of the lease payments over the lease term using the discount rate. So back to those other slides where we kind of went through the definitions and what they mean. So putting it all together, that's how we're going to calculate our lease liability. And then our right-of-use asset is going to be made up of that lease liability, again, at commencement date, plus any prepaid or accrued lease expenses, or lease incentives, and then plus any direct costs incurred by the lessee. On the next 5 or 6 slides, I think it is, we'll go through kind of some simple examples. Again, just so you can see kind of what it looks like, and then also see differences between how an operating lease looks for journal entries and calculation, along with how a finance lease looks using the same assumptions. So in our operating lease example, again, this is a simple example. We have a 3-year lease, monthly payments of $1,000 in year 1, $1,200 monthly in year 2, and then $1,400 monthly in year 3. No renewal options. There are also no purchase options, no incentives or other costs. I have an amortization schedule on the next slide, but using an incremental borrowing rate of this 4.7, it results in an initial measurement of the asset and liability at $40,000. So again, taking these inputs, so our monthly payments, and then taking our incremental borrowing rate, we can put it into an amortization schedule, and we end up with a present value initially of $40,000. What does that mean for journal entries? So at our commencement, we're going to have a right-of-use asset for $40,000, and then we're going to have a lease liability of $40,000. And then the monthly journal entries are going to be based on that previous amortization schedule. So in month 1, if we go back to the previous slide, since we have an operating lease, our rent expense is going to be straight lined over the lease term. So every month it's $1,200. Lease expense debit at $1,200. Our lease liability, reduction to lease liability, is going to be this $842.83. Our cash that we paid, we're going to credit for $1,000, because that's our monthly payment in year 1. I have an error here. This should be a credit, not a debit. But the plug is going to be to our right-of-use asset, a credit of $1,042. And so what this looks like over the course of the 3 years is that we have our cash payments on top. So we're going to be paying, that $1,000 a month in year 1 is going to be $12,000 in cash. $14,400 in lease expense over the year, because we are straight lining it. So it's going to be equal lease expense over the 3 years. And then at the end of year 1, our right-of-use asset is going to be $27,000. And then our lease liability is going to be about $30,000. Year 2, you can see kind of impact there. And then finally in year 3, at the end of the lease term, we have no asset or liability because there are no, it's over. Then conversely, we'll go through a quick little finance lease example. So we're going to assume the same facts in the previous example. However, it was determined to be a finance lease. Maybe the present value was 100% of whatever we're leasing here. So our initial journal entry, again, still that same debit ready-use asset, $40,000, credit lease liability, $40,000. However, this is where it's going to be a little bit different. So we're going to record amortization on the right-of-use asset. So this is going to be straight lined. So think of our $40,000 divided by the 3 years or 36 months. So we're going to have a debit to amortization expense of $1,111 and a credit to our right of use asset, or if we have a right-of-use asset accumulated depreciation or amortization, that would be our credit there. The monthly cash payment to record the lease payment. So we're going to debit our lease liability $1,000, credit cash $1,000. And then we're also going to record the interest expense. We're going to debit interest expense for 157, and then we're going to credit lease liability for 157. Again, this all rolls into an amortization table, so you can get the figures. And so here is the table for that. Again, our initial lease liability of $40,000, our monthly amortization of $1,111, and then our interest of 157 from the previous slide. So kind of a 3-year summary. What does it mean? Cash payments are the same. Because this is a finance lease, we don't have that one account called lease expense. We actually have 2 different accounts. So we have interest expense, and then we also have amortization expense. And then again, at the bottom are right-of-use asset and lease liability over the term. Now, what's the difference between the two? In this example, we can see our first 2 are right-of-use asset for a finance and operating lease, year 1, 2, and 3, our lease liability, again, year 1, 2, 3, and then the expense. So ultimately, in this example, it's relatively minor differences, but the exercise is just to see that there are differences between the 2. And then, I think where we started the conversation was if we have one lease, it's not to say it's easy to do, but it's easier to handle one lease. Now, imagine running amortization tables for 10 different leases. That's where it gets very complex if you're just using spreadsheets trying to figure out, all right, so this spreadsheet plus this tab plus that tab, and rolling it all into one can get very complicated and prone to kind of just human error, which results in kind of that back to the highlights slide where we said, we see this being kind of a software solution to try to take out kind of that human error piece, and even just to automate the amortization calculations and financial disclosures, similar to that of like our, for those of you that are Wegner clients, we maintain depreciation schedules for a lot of the organizations that we work with. I suspect leases could be the same depending on the lease portfolio. So now that we've done the calculations, the journal entries, what does it mean for financial statement disclosures? So our qualitative disclosures, the types of leases that we have, any significant assumptions or judgments, our accounting policies, and any elections we made, for instance, the short-term lease exception. So those leases that are 12 months or less. And then the kind of the complicated part, if you have more than a handful of leases, is going to be these quantitative disclosures. So finance lease, we need to disclose how much. So for finance leases, we need to disclose the amortization and the interest expense components separately. We need to disclose operating lease costs. So for those operating leases, we need to disclose short-term lease costs. So those 12 months or less leases. If there are variable lease costs, those also need to be disclosed. So as you can, we won't go through all of them, but as you can see, again, if you have more than a handful of leases, these disclosures are going to get complicated really quickly. So kind of just some quick tips for getting ready. review your contracts and GL payments to identify or create an inventory of leases. Be aware of potential embedded leases, so those service contracts where assets are included with services that could qualify as leases. You may need to set up a new procedure for tracking leases. So again, back to those implicit or embedded leases, those contracts may not have come to you previously that contain leases, and now they may need to come to you for an evaluation. Deciding what practical expedients or accounting policy elections to use. And then for those organizations where you might have debt covenants or specific ratios you need to meet, is the new standard going to impact those? And should we be having proactive conversations with our lenders or other stakeholders? And then just overall kind of a general understanding of the amortization tables and what GL account impact it's going to be. I suspect that most organizations are going to have to create some new accounts to make the disclosures easily trackable. Instead of just putting everything to a rent expense, it might need to be broken out into those different accounts. So amortization, rent, lease interest. If there are short-term leases, that could be an account. If there are variable payments, that could be an account where the excess is quoted there. So there's kind of just some fundamental things that might need to be thought through before implementing this if you have multiple leases and a variety of different things in your contracts. And then maybe just one there, obviously the FASB has a lot of new standards that they release, but for the majority of nonprofit organizations, they don't really apply. One that will apply is going to be this credit losses. It's not effective for, I think, a couple more years, and it's going to primarily relate to, the estimation of allowance for doubtful accounts on your earned revenue, so your program revenue, not your promises to give, but that's excluded from the standard. So just your exchange transaction revenue. And then loan losses. So if your organization lends money to others, how you estimate the allowance for loan losses is probably going to be somewhat impacted. Then it looks like we might have a couple of questions that came in, Kristen.
Yes, we do, Tim. The first one's going back to in-kind. Is in-kind rent listed on the statement of financial position as an asset liability or on the statement of activities as in-kind or both?
So in-kind rent is going to not be included in the lease standard. It is just going to show up, is going to be covered under that gifts in kind standard. So it's going to show up as an in-kind and disclosed under that standard.
Okay. Would we not credit an accumulated amortization account?
Yeah, so in the example I just used ROU asset, you could create a ROU amortization similar to how you would account for fixed assets. That would be kind of an internal determination how you wanted to track it. It makes sense to do it that way.
Okay, and then the last question from over in chat. What if you are currently on a month-to-month lease and have been for years?
Yeah, so that is a tricky one. It's probably going to be dependent on what the original agreement said, which may go back years. So if the original agreement was, hey, we're going to lease it for 3 years, and then after that, it's going to be month to month. Well, in that original agreement, it may state how the contract or the lease could be terminated. So if it's a mutual termination, then If the lessee or the lessor could terminate, then I would suspect you don't have to do anything. If it's less or termination, then obviously not do anything. If it's silent on how the lease would be terminated, that's kind of the gray area that we're working through right now. The technical language might say you need to obtain a legal opinion on your rights there, but practically speaking, that's kind of one of those gray areas that we're going to figure out over the next several months as we kind of get into the standard a little bit more, have additional trainings, and see some practical real world examples that we can then share with our clients.
Thank you. One more question just came in. The example goes over a lease from the start, but how will it work for leases we're already in the middle of?
Yeah, great question. So that is going to require what is called a kind of a cumulative catch-up journal entry as of, well, it's going to be as of 1/1/22 for calendar year end organizations. Now, for those leases that are already in existence that are expiring within 12 months of 1/1/22, you don't have to calculate it, but if you're in year 3 of a 7-year lease, you will have to calculate the future, the asset and liability as of 1/1/22 based on payments for 22 through the end of the lease term.
Are there any special considerations for lessees who rent property to others?
The standard does talk about lessors. Generally speaking, there really aren't any changes. There's not really significant changes to how lessors do their accounting.
Okay, that's all the open questions for right now.
All right. So looks like I got about maybe 15 minutes left or so. Just a quick, we'll go through this probably in just a few minutes here. So COVID-19 funding and compliance update. I'm sure most organizations are well aware of it, but we'll just kind of go through some slides here about different programs that were out there and what potential impact it could have to your organization. So the first being the PPP program, so the SBA's Paycheck Protection Program loans. There were, background, there were 2 loans that were forgivable if you met certain criteria. Nonprofits could choose their accounting policy here and either use the debt model or the conditional grant. In other words, the contribution model. The table kind of shows the accounting for the PPP loan based on which model is selected. Kind of the important or the item to note here is that PPP loans are not subject to single audit requirements. There was a economic injury disaster loan program through the SBA, the EIDL. It was also obviously a loan program. It gave out forgivable advances of $10,000, and then anything over that was considered a loan where interest was deferred for 24 months. The advances, so that first $10,000 is not subject to single audit. The loans, however, are subject to single audit. Employee retention credits. So these are refundable tax credits designed to encourage employers to keep their employees on the payroll. Qualifications to ERC are subject to certain eligibility requirements. It is not a loan. The accounting for ERC is likely to be considered a form of government grant. The IRS is significantly behind on processing pretty much everything. So likely the accounting for it is going to be when you submit the ERC, the credit for that, you're going to record your accounts receivable and other income, or wherever it's wherever you put it, depending on the materiality of it. If it's a very significant amount, it might be reported on its own line. And then again, similar to PPP, ERC funds are not subject to single audit. I'll also give a quick shout out to if there are people watching the webinar that are needing assistance with ERC, we have a team of folks here that have been processing claims for clients, or helping them submit claims for credits throughout the last year. I think I saw an email the other day that we've helped clients claim about I think it was over 16 million in credits throughout the year. So if you guys need assistance, please reach out to your advisor, or you can reach out to me, and we can get you hooked up with the right people if you need help. Shuttered venue operators grant. So this was very specific eligibility criteria here. Under the terms of the grant, recipients are not required to repay if they're used for eligible expenses. Again, most likely accounted for as a conditional grant. The shuttered venue operators grants are subject to single audit requirements if you're over the threshold. And then one of the more common COVID relief programs was provider relief funds. There are several other, like the coronavirus relief fund, but I want to talk about the provider relief funds because that has been, in our experience, the most challenging or confusing. So generally considered conditional grants where revenue is recognized to the extent that you have qualifying expenses or lost revenues that have been incurred and not reimbursed from other sources. When I was speaking to challenges, it has been because the HHS, so the Federal Health and Human Services, has not been timely in issuing guidance, and they've issued guidance and then issued revisions to that guidance several times throughout the year, including how to calculate lost revenue. And then there's also confusion over GAAP reporting and then how or when you record it on your schedule of expenditures at federal awards. And then because they are CFA eligible, the PRF funds are subject to single audit. All right, so the CFA reporting confusion. So in the table here, we have our year end on the left, and then what's included on the CFA. So if your year end is before 6/30/2021, no PRF funds are reported on your CFA, even if you have eligible expenses and lost revenue. For those year ends 6/30/21 through December 30, 2021, so not December 31st, the period 1 payments submitted to the PRF reporting portal are required to be reported on the CFA. Only period 1 though. So for our 12/31/21 year ends through June 29th, so not 6/30, both period 1 and 2 would be reported on your CFA. And then for year ends 6/30/2022 and later, there's no guidance yet, which will be provided at a later date. Now, HHS reporting, so periods, here's kind of the definitions for period 1, 2, 3. It's based on your payments received, period of availability and the deadline to use the funds, and then your reporting period. So you should be able to see from the previous slide that we could have expenses reported or revenue recognized in 1 year, but then the expenses that would get reported on the schedule of expenditures of federal awards reported in a different year, which has created confusion as to what's going on. How can I have revenue and expenses in 1 year and not reported on the CFA until the next year? So if you have PRF funds, these tables will be helpful to you in figuring out what gets reported when. And then kind of just a general overview of COVID funding. What should we be disclosing? So a general requirement is that entities are required to identify and describe accounting policies that materially affect their financial statements. So if you have received a material amount of COVID funding that you're making a like PPP loan, for example, that you're making a accounting policy election to use the conditional grant model, that should be disclosed. If you have maybe significant amounts of ERC, maybe you're disclosing something around the timing of when you're recognizing that. So just kind of an overall, keeping your head depending on what you're receiving, should there potentially be additional accounting policies that we disclose in the financial statements for the year. And then with that, Kristen, looks like we might have a few more questions.
Yep, a couple more here. For building rent leases, do CAM charges need to be accounted for separately?
Those would be typically, most likely, variable lease payments and excluded.
And when do you expect you'll have software to help nonprofits calculate their lease related entries?
Soon. So I guess thankfully I'm kind of the guy that's in charge of figuring out what we're gonna use. So it'll be, we should have a software in place by the end of the year. Probably training our staff early January, I suspect, and then make it available to our clients probably shortly after that. So early next year, I'd say, as far as when as clients you might see it.
Great. And that is all I have in the Q&A box for now. If anybody has any last minute questions, feel free to throw those in there. Otherwise, of course, you can see Tim's contact information is included here on the last slide. Feel free to reach out to him if anything comes up after this presentation. I will be emailing you the recording from today, as well as Tim's PowerPoint presentation for your reference a little bit later this afternoon. So if nobody has anything else, Tim, I think we're all set.
All right. Well, thanks everybody for joining.
Thanks. Have a great day.